Oh, this is the time of the year that you've been waiting for, Q3 2023 Canadian Banks Review. I must say I was super excited. I just came back from vacation and then I'm like, yeah, in a couple of weeks, Canadian banks are reporting their earnings. Started with Royal Bank and TD Bank going into two different directions and then boom, gotta wait because CIBC just like, yeah, I'm kind of shy to share my results. And they pulled them off this morning, and actually they should have just don't say anything because they were not great. A kind of funny thing is when you read the quote from the CEO, he says, oh, we pulled out solid financial results considering what's happening. And then they say that their earnings per share are down 18%. So I'm not too sure how to interpret that, but then that's for later on in this video. So Dividend investors, bonjour. My name is Mike Yehu. I am the founder of Dividend Stocks Rock, and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And I know that a lot of retirees have banks in their portfolio because they're great. They work in an oligopoly. They pay a great dividend, and they offer sometimes some good, some growth as well. So that's a pretty good balance for an income-seeking investor that is looking to get some total return. But over the past few years, it hasn't been that great for banks. So let's start with year-to-date return going from the small banks, EQB and GoEasy, completely destroying the competition on that regard. Keep in mind, they are like small companies compared to the other banks, and they are niche companies as well, and we're gonna get there to the results at the end of this video, don't worry. That will explain why they are such on a roll compared to the other banks. We have National Bank, my favorite, that is usually outperforming the others. It's still the case right now, but one thing that I want to drag your attention here is the difference between the BMO covered call, ZWB, versus the BMO equal weight bank, ZEB. Why? Well, when the market goes up, technically, you should get exercise on your options when you write covered calls. And then that limits your potential of increase. But when you go on the other side and the banks are going down, well, technically, people writing up options, they should just make cash and keep their assets. So technically, it should be even better than holding the stocks altogether, right? You see what I'm saying here? Well, it's not happening. So even if you are getting a better yield, when you look at total return, and I have to repeat that, total return includes stock price appreciation plus the reinvestment of those dividends. So when you think, oh, you didn't account the dividend, yes, it is part of the total return. It's still underperform having just banks, and if you make a good selection and you ignore CIBC and Scotiabank and you focus on the other four, well then you're gonna easily beat both ETF, ZEB, and the other ETF, the covered called ZWB. Now let's get on with the results, which were not really good, to be honest, unfortunately. As you can see on this graph, most banks reported double-digit decline for their earnings per share. Just National Bank did a little bit better at -6, TD did a little bit better at -5, and boom, big surprise, Royal Bank is up double digits. So we're gonna talk about that in a moment, but overall it was a pretty bad quarter. The same songs are put on repeat right now, so we're talking about higher revenue because we charge more interest on loans, a lot more volume because people seek desperately credit. But on the other side, we have a lot more provision for credit losses, and we started to see some more higher impairments. So that means that the first step when you look at your loan book is, yeah, this one is good, this one is good, this one not so great. I might lose this loan because that client seems to not be in a good financial shape. So what I do is I put this one in my provision for credit loss, saying, you know what, I might lose it. The second step is when that loan goes into collection because the client stops paying, eventually I have to write it off my book, and that confirms the provision for credit loss. So obviously the provision for credit loss reduces the earnings up front, and then a year later we look at the loan and say, well, is it still alive? Is the client still paying off, or it's gone into collection and we'll have to write it off because chances of getting our money back are getting slim to zero. When it happens, we see that as an impairment. So the play here is we always hope that banks are ultra conservative, which is the case. So then when they increase their provision for credit losses, eventually the year after they say, oh no, well, we put like 700 million, but really it was not 700, but rather 500. So boom, $200 million goes back into the earnings, and then the earnings per share goes up and the market is super happy, but they don't realize that banks never just lost those money and are not making more. There was just like accounting like principles. In terms of payout ratio, again, nothing to worry about, but just a highlight with CIBC and Scotiabank at 57% and 61%. That's kind of like a high payout ratio. So I would not expect them. I mean, you can see the link here. You have like higher yield, lower PE ratio, worse performance, and higher payout ratio. You can see the narrative building up. All the numbers are pointing towards the right direction. CIBC and Scotiabank are not performing well, and eventually that will restrain them to keep up with a high single digit, like the 5 to 7% dividend growth rate that most banks have in terms of dividend growth policy. At one point, they will have to put a stop on that and maybe go back to 4, 3, or 2%. So we'll see what's coming up in the next quarters. But in the meantime, just put that in your mind. For the others, everything seems great. We're like high 40s, low 50s. Everything seems fine. So it's not the end of the world, but obviously banks are not making much money this quarter. In terms of results per segment, we see a lot of different numbers, a lot of double-digit drops, and from time to time we see something that goes up. So let's start with BMO. That reflects pretty much what's happening across personal and commercial loans and banking. The overall net income is down slightly for most banks, but revenue were up big time. So revenues are usually up almost like high single digit to double digit because of higher interest rate charge on loans, but the provision for credit loss wiped it all. BMO benefited from a strong exposure to the US market, and the currency fluctuation was on their side for this quarter, so their US segment was up double digit, was great. On the other side, they recently acquired Bank of the West, and this is why wealth management is down by 16%. There were a lot of fees linked to that transaction, so nothing to worry about too much. And then capital markets, as you can see on that column, it could kill you or it could save the day. That's pretty much what's happening. It's a highly volatile market depending on what they do and how they do it and how like they manage their trading. Banks will either generate double-digit returns or double-digit declines. So for BMO, it was a good thing. For National Bank, pretty meh quarter. They missed analyst expectations. Personal and commercials up 3%. The US and international surprisingly was up 2%. Provision for credit loss in those, especially in Cambodia, was a bit worried about that, and their specialty credit segment in the US, but they remained flat, so that didn't impact too much their net income. So plus 2%, nothing to write home about, but at least it's not negative. For the wealth part, up 5% on stronger revenue, stronger as the market goes up. They usually do this business and wealth management. What they do is that they charge on assets under management. So if the market goes up, your assets under management goes up, even if you don't get any new clients. So you're just making more money because the market is on your side. So again, plus 5%, that's great. But capital markets, definitely not the right time to be there for National Bank. I guess they missed a few trades. Higher expenses also are included in this one, so down 27%. Overall, not really a good quarter for National Bank. For TD, wasn't that great either. As you can see, they had to take a lot of fees and a lot of charges because they decided not to go with the acquisition of First Horizon. So that's why on the US side, it's down 9%, down 12% for wealth management, and then wholesale was flat. PNC in Canada was pretty much flat. But the big news was TD announced a 5% buyback program. So they intend to buy back about 5% of their shares, which is great news, telling us that management is confident in the business and that likely they think that TD's shares are undervalued. So we'll see how it's going to happen, but in the meantime, very good. Royal Bank had the best quarter among the big six, mostly because earnings per share were up like double digit, plus 11%. That was driven by like two main things. The first one, lower taxes for this quarter. So on this one, it may not repeat in the future. It was just like a mix of how much they make money and how they make money and how they're taxed on it. So do not necessarily expect that they will be able to do that trick again, but still, personal and commercial was up 5%, insurance, which is a small segment, up 22%, wealth was down 18%, but capital market did a hell of a job at plus 57. So between the low tax, an okay quarter for personal and commercial banking, plus a strong quarter on capital markets, Royal Bank really stole the show on this one. For CIBC, I told you before, they were down big time. Their result sucks. It's been a while, and now we can see that they're increasing their provision for credit losses on their US segment at a faster pace than anybody else. Minus 64% in net income for US, all driven by higher provision for credit loss. This is somewhat concerning. I don't expect that CIBC will have a good day and yet let alone another good quarter on the stock market until they report better numbers. On Q1 and Q2, it was a little bit better, but then they're going back into that slump. So definitely starting to lose faith on this one, not seeing like how they can manage going forward. And finally, the other laggard of the group, Scotiabank, personal and commercial banking down 13%, and on their international segment that is put in the US on this chart because I don't have like US exposure, and you know Scotiabank is like the most exposed to the international market. They were flat, but just based on currency. If not, I think they were like down 8% or something like that. So not really a good quarter for them either. A lot of provision for credit losses, a lot of higher expenses, and overall, we should just all forget about this quarter altogether. In terms of valuation, the PE ratio over the past 12 months is, since the beginning of the year, is pretty much in line with what we have seen so far. Scotiabank still lagging behind, but there's a good reason for that. Royal Bank and BMO at the top, and then we have National Bank, TD, and CIBC pretty much at the same valuation, around like 10.5%, as the 10.5 times the earnings. Sorry, guys. When you look at the forward PE ratio, then you can see that CIBC and Scotiabank are still lagging behind, and it's not because they're offering more value, it's because they lack of growth vectors, and the market reflects that in their pricing. So do not think, oh my God, I'm gonna buy CIBC at 8 times the future earnings in 12 months, and it's gonna go back to 11 times and reach Royal Bank and TD Bank's valuation. It's not gonna happen this way. Those two banks are more diversified, they have more growth vectors, and CIBC and Scotiabank are struggling with a lot of their business segments. So do not think that it's going to magically reappear at a 10 times or 11 times their earnings. They are here for a reason, they're laggard for a reason, it's been a while. So please do your due diligence before making any trades. Now let's move on to more positive news, shall we? EQ Bank and GoEasy just had another amazing quarter. That's kind of crazy. EQ Bank earnings per share up 14%. Customer signups 133% higher than Q2 2022. That is also because they introduced the EQ Bank card. Their expansion in Quebec is doing very well, and they also even offered a small dividend increase of 2.7%. The only thing I do not really like about EQ Bank at this point is they still have a very low provision for credit loss, and they're still incredibly enthusiastic about their underwriting process and how everything is perfect in their world. I mean, it's gonna like create a contrast between what the big six say about the economy and what EQ Bank and GoEasy. They're just like, yeah, that's business as usual, and just we're growing double digit. On the other side, they are actually pulling out those numbers. So at one point, not too sure what's going to happen with those, but definitely EQ Bank is a top performer for a reason. For GoEasy, it had a terrible year on the market in 2022. Yet they continued last year and this year to report strong number. Actually, this quarter it was a record for loan creation for $667 million. There is a strong demand for credit, and in terms of like their net charge-off and their provision for credit losses are pretty much stable from one quarter to another. It's in line with their expectation in their business model. So they're saying, you know what, it's business as usual. And even if we had new federal regulation where you cannot charge like a super high interest rate, they said that because the rest of their business model is now benefiting from a higher interest rate environment, it's not going to change much, and they're still confident to continue to report double-digit earnings growth, which is kind of crazy. And for GoEasy, it's still lagging compared to what it like in terms of stock price if you look at where they were in January of 2022. So you might want to dig into this one a little bit more just to see if there's a possibility that there's an opportunity with EQ Bank and GoEasy. But between both, EQ Bank is performing better, but GoEasy seems to not getting love enough by the market and still performing. So that rings a bell for me on my checklist. If you are confused about the market right now, if you're not too sure about what to buy or what to sell, I will host a webinar for everybody that is on my newsletter on September 21st. I actually reached out to my list, like over 25,000 readers last week, and asked them what they want me to talk about. I received like hundreds of answers, so I'm not sure yet which one I'm going to talk about, but it will be either the buy and sell process, how to create dividend income, or how to get out of paralysis by analysis. In either way, you're going to have an amazing webinar, like a 45-minute to an hour presentation, and then I'm going to stay live for an hour and even more than that to answer any kind of your question. So please register to the newsletter, the dividendguyblog.com/newsletter. So you have the link right there, the dividendguyblog.com/newsletter. You register there, you receive your invitation, and we have 500 spots for the live event, and after that, everybody that registers to the webinar will receive the replay for free. I usually give some newsletters and some tools during those webinars, so I think it will be a great way for you if you want to start this quarter, the next quarter, on a strong foot and end up the summer and go right into this fall with a solid portfolio. This webinar is for you. So to end up this video, what we have learned from this quarter, well, it's more, we didn't learn anything new. It's more a confirmation of what's going on. So definitely winter is coming. We can see that. I've discussed that on my podcast. We had like results from railroads saying that transportation volumes going down, from retailers like Canadian Tire and Walmart in the US saying, you know what, people are like, consumers are spending less on discretionary expenses. So we see everything slowing down, and then with the banks, we see that provision for credit losses continues to go up. Now we see more impairment going up, and even though we have strong volume for loan, it may not be like the best scenario possible, because maybe some of those loans will eventually go back into the provision for credit losses in the end, like in a year or two. So just have to be careful with that. Besides that, banks remains very cheap. They work in an oligopoly, which is pretty much like a good place to put some money in. The federal government will not let them die, and we're very far away from that part. So overall, still a good holdings, but you will have to remain patient and do not necessarily think that you're going to outperform the market with Canadian banks over a short period of time. I will just end up this video with this graph where it shows the total return for all the banks for the past 5 years, and just to show you how most banks didn't beat the TSX 60. So GoEasy, EQ Bank, National Bank did better, but all of the others are below 46% total return. That is just a lesson for you guys to not think, oh, because I buy banks and all banks are equal. Well, they're not, because CIBC and Scotiabank are up like 10 and 17%, including the dividend, while you have like Royal Bank that is up like 43%, and then National Bank up 81%, and the small two niche banks are up 158 and 173. So you have like a wide range of returns here. So just picking up banks for the sake that they have the word bank in their name, not necessarily going to work out. So my suggestion here, do your due diligence. Understand what's the difference between each bank and each business model, because they are not the same. All right, guys, that's enough for today. Leave me your comments about the bank's quarter this time. Don't forget to register to my newsletter to receive that invitation for the free webinar. So it's at dividendguyblog.com/newsletter. And we're going to see each other again next week. So stay tuned and stay invested.